the PowerPoint, and let's look at these and let's talk about them. We're going to match, and you'll probably see something like this on your Chapter 2 quiz, just like we're going to have for Chapter 1, Chapter 2. Let's match these items with their category on the balance sheet. So we're going to look at current assets, current liabilities, long-term investments, long-term liabilities, property, plant, and equipment, stockholders' equity, and intangible assets. What's a salaries and wages payable? Anyone? Current liabilities. Service revenue? Boy, that's tricky. Service revenue is really an income statement account, isn't it? It's really a revenue, right? And ultimately, it flows into the stockholders' equity section through retained earnings, ultimately. But for this purpose, they didn't, if the item would not appear on the balance sheet, use not applicable. NA, interest payable. Current liability, goodwill. Intangible, depreciation expense. Not applicable. Again, expense, it's an income statement item. Mortgage payable, due in 3 years, not 1 year. Long term. Investment in real estate, long term. Equipment, PP&E. Accumulated depreciation is also in PP&E. That's kind of tricky, but no, it goes against the depreciation. Debt investment, short term. Short-term debt investments, a current asset. Retained earnings, stockholders' equity. And unearned service revenue. What did we say that is? Current liability. For Chapter 2, guys, you're going to see something like this, okay? Make sense? Now, I'm not going to get into much of this ratio analysis. We will deal with this in the future chapters. But know that a lot of times the way we compare companies to one another is by using ratios. So we can look at their current assets and we look at their current liabilities and we call it a current ratio, current assets to current liabilities. Or sometimes we have something called a quick ratio where we take just cash or quick assets to current liabilities. And so it's all these ways of determining, like return on investment. Have you ever heard that saying? The ROI, or return on investment? These are all ratios we get by looking at the income statement and the balance sheet and calculating the various ratios. And we'll compare, Target's is this and Walmart is this. These are just ratios to make some sense out of companies, okay? So know that there are various ratios. They're broken into 3 types: profitability, liquidity, and solvency. But guys, I'm not going to spend any time, you're not going to have anything like this on the test. We're going to get into those down the road, okay? I'd rather focus and stay on track with what we're talking about. Debt to equity. Do you ever hear airline industry? They have a lot of debt. Why do they have a lot of debt? They have huge, heavy equipment, don't they? Huge equipment that costs millions of dollars. Certain companies, like technology companies, don't have a lot of assets and therefore need a lot of debt. Does it make sense? So you can't necessarily compare an airline industry with a technology company because they're two different animals. But you can compare American Airlines to Continental. Okay? Make sense what I'm trying to tell you? And those ratios are numbers taken off of financial statements. So basically, this example is with Best Buy, you can have 2 years next to each other. And we can compare 1 year to the next based on various numbers on the financial statement. And so in this scenario, earnings per share is basically what's the net income based on the total number of shares outstanding. So EPS is basically taking their net income and averaging their shares and coming up with how much does each stock really earn? Make sense? Okay. So basically in doing this, it allows us to get an understanding of comparing companies. Okay. Now, this is called a classified balance sheet. This is just the term of a balance sheet where we have them broken down into current assets and property. They have some of the various areas, and they're comparing one year to the next of a normal company, Best Buy. Now, when we're dealing with balance sheet, I'm not going to get into any of this right now. I just think I'm better off not. Solvency is basically, can a company keep paying their bills? Again, I'm not going to spend time getting into the ratios because we will deal with that down the road. Here is an interesting chart, though, that different companies have different types of debt. This is a ratio called debt to assets, where they take the total debt and they take their total assets and they compare how much their debt is to their assets. And as you can see, this pharmaceutical company has very little debt. But when you go and look down at General Motors, look at the debt they have. Does it make sense? Do you see how you can't really compare pharmaceutical to GM? But because each company or each sector within an industry has unique situations in their own rights or in their own situation. But you can see that depending on a company, it's going to vary all over the place how their balance sheet or their income statement play out. Bottom line is you want to keep focus on how much cash is available. Cash is king. I always tell people, you can have great ideas, you can have great plans, you can have a great product, but if you can't sell it, if you can't stay in business, are you going to make it? I have so many clients that come in my office, they have the greatest ideas, but a great idea is just one half the battle. You need money to make money, okay? And you need to stay in business longer than a month or 2 months in order to sustain the business. How many of you guys go to a restaurant to find out it got closed down 2 months later? We had the best new Mexican restaurant in Red Wing. It was awesome. It was in business totally for 3 months. Well, they probably didn't have the resources because they probably were a proprietor, and they didn't have the funds to stay going longer and to compete with the big honcho down the street, the Mexican restaurant down the street. But you need money to keep going. So all these various ratios help you compare how companies are doing. Okay. Generally accepted accounting principles. This is what we are going to talk about. So as you can tell, if I skipped over it, Nick, you don't have to worry about it. Okay? Generally accepted accounting principles are an important concept to understand. This is GAAP, or generally accepted accounting principles, are the guidelines that accountants must adhere to in order to provide accounting financial statements. So they are basically the authority that the accounting industry uses as a guide for reporting financial statements. Now, there are other bodies that we have to adhere to. The SEC runs the stock market, the Securities and Exchange Commission, and they have some guidelines that are important to adhere to. The FASB, or the Financial Accounting Standards Board, is another body that sets guidelines. There's the International Standing Board and the PCAOB. The main one I want you to understand is that generally accepted accounting principles are adhered to, and everyone needs to follow them. So they will provide us with guidelines such as certain things or most items on financial statements have to be recorded at what's called the historical cost principle, which means it's what you bought it for. Or there are GAAP guidelines regarding, let's say we have inventory that's become worthless. We have to record our inventory at the lower value of cost or market. Okay, so if the inventory has declined in value, we have to adjust our inventory, not to show what we bought it for, but what is it really going to go for in the market, lower of cost or market. There are all these things we're going to talk about, but they're guidelines called generally accepted accounting principles. Generally accepted accounting principles are A set of standards and rules that are recognized as a general guide for financial reporting. B, established by the IRS. C, the guidelines used to resolve ethical dilemmas. Or D, fundamental truths that can be derived from the laws of nature. A. Okay. So, the important piece in financial statements, we are really providing a lot of information, even though it's in the form of numbers. We're really providing a lot of information as a result of financial statements. And this information that we're providing needs to have two important pieces. One, it needs to be relevant. And two, it needs to have faithful representation. It really needs to be representative of the company we're dealing with. So what is the term relevance? And this is something, guys, like I said, all those ratios and solvency, I'm not going to ask you about any of that, but I want you to understand why this is important, and it will make more sense as we move on. Relevance, so information is relevant if it would make a difference in a business decision. Information is considered relevant if it provides information that has predictive value, which helps provide accurate expectations about the future and has a confirmatory value. It confirms or corrects prior expectations. So it's relevant because it's really what's happening in the business. It's really the truth of what's going on. And I'll explain why this is important, because a lot of companies don't give you the truth, do they? I just heard driving in here, Citibank just fired like 15 people for fraudulently representing something within Citigroup again. You know, it's like, when will the fraud ever quit? It's not going to ever quit. Materiality is a company-specific aspect of relevance. An item is material when its size makes it likely to influence the decision of an investor or a creditor. So it's important that the financial information accountants give is relevant, and relevance is based on materiality. Let me make an example of what that means. Let's say my little shoemake CPA shows a balance sheet item and I misstate my cash by $20,000. Okay? With my little business, $20,000 to a bank might be significant. It's material because my profits, you know, are not like a Wells Fargo. But is $20,000 to Wells Fargo material? No. So materiality can be subjective. Do you understand what I'm trying to get at? If I inflate my revenues, let's say, by $100,000, that might be really material because my revenues might only be $300,000. Okay? But if Target misstates their revenues by even $1 million, based on the monies they bring in, that might not be material. So materiality is related to the current situation. So why is that important? Do you guys remember Denny Hecker?
Yeah.
And remember he got into trouble? I'm going to turn this off right now. Remind me to turn it back on. That regarding accounting information, it needs to be relevant, and you must represent it in the truest sense of the form. And part of this aspect of relevance has to do with materiality. Items that are material in nature can change people's views. And materiality is subjective based on the company and the specific set of circumstances. Faithful representation means that information accurately depicts what really happened. To provide a faithful representation, information must be complete. Nothing's omitted. It's got to be neutral. It's not biased. And it's free from error. So, for example, faithful representation, what it is not. How many of you guys remember WorldCom back in the 90s? WorldCom was one of the big, around Enron, they went defunct. Well, what WorldCom was doing is they were leasing underlying cable lines underneath the ocean. And it was truly not their property. They were leasing it like you and I pay a service charge for internet, okay? But they showed it on their books as an asset. So think of this. Every month when they went to write a check for $1 million or $2 million to Joe Blow for helping use these cables, instead of treating it as an expense, they treated it as cables, like an asset. What it did is it showed their income was much greater than it really should have been, okay? Because it should have been recorded as an expense, but it wasn't. And then it also showed their assets were so much bigger than they really were because it wasn't an expense, an asset. Think of it like this. I pay internet fees each month of, say, $300 or $200. If on my business, instead of showing internet expense, I show internet equipment each month, $300. At the end of this year, I have $3,600 in internet equipment. What do I have to show for it? See, it's fake. So they weren't having faithful representation of what's really going on. Do you understand what I'm saying? So once someone found out that all these years these cables weren't really assets, they were expenses, they went bankrupt overnight. Because all of a sudden, their situation went from being a profitable company to a joke. Am I making sense? So faithful representation really is that you're depicting the way it really is operating, what's really happening. Qualities of useful information. For qualities to be useful, you've got to be able to compare them. That's why we all have to adhere to similar guidelines, so we can compare one type of auto industry to another automaker. So you can compare them. So if one company is using Euro dollars, and we're supposed to be using US dollars, and then General Motors is using US dollars, how can you compare when we're not working on the same base? Am I trying to make sense? That's the truth, the same truth with certain guidelines that that GAAP requires us to adhere to. You have to utilize certain standards. And so you've got to be able to compare it. It needs to be verifiable. So in other words, let's say we go and we look at someone's financial statement and it's like, well, how'd you come up with revenues of 10 million? We should be able to go and find the source to show it's true. You see, information in financial statements has to be verified. Otherwise, anyone can just rig whatever they want. It needs to have some sense of understandability. We got to be able to understand what it is, which that's a whole, I don't want to get too caught up, but we got to understand it. It's got to make sense to the average user. It's got to be consistent. So if in 1 month we use US dollar standards, we can't in the next month use euro and combine them all. Make sense? And it's got to be timely. What good is information if it's 3 years late? It's already gone and done. So just know, I'm not going to sit there and ask you about each one of these, but it needs to be able to be compared to other years or to other companies. We've got to be able to know it's accurate. We should be able to verify it based on paperwork. We need to be able to, like, for a common reader, understand what they're trying to say to us. It needs to be consistent between periods or between years or between users. And it needs to be done within a timely manner to where it's still important for us. If it's outdated material, it's too late to make any information out of it. Okay, assumptions in financial reporting. Monetary unit. We don't do anything based on iPads. We do it based on the dollar, don't we? That's our monetary unit everyone has to adhere to. And we don't do it based on Nancy Shoemake, CPA with Nancy the person all coming together. We base each business on the fact it's a separate economic entity. So Ford only shows Ford's information. Chrysler only shows Chrysler. What did Enron do? Enron really messed everyone up. Enron had all these subsidiaries. They took the good about the subsidiaries, the revenues, the assets, but they took the subsidiaries' debts and took them off balance sheet, which means they went and showed them on other entities. So Enron needs to be Enron, and if there are subsidiaries attached with it, everything should be reported, not pick and choose. Make sense what I'm trying to say to you? When you guys go and fill out your information for FAFSA or whatever, you use your information. Can you go use your next door neighbors too? You see, you're a separate entity. This is a basic assumption we use in accounting, that each entity stands on its own. So monetary unit, only those things that can be expressed in money are included in accounting records. Economic entity states that every economic entity is separately accounted for. Periodicity means we do it within a period of time, within a month or a week or a year. We don't do it for 5 years in a row. We have a time frame, a beginning period we're reporting on and an ending period we're reporting on. And all of this, the most important piece here is that we're not going to show financial statements for an entity unless we expect it's going to continue. So when we look at Delta, we anticipate they're going to be alive, or they're going to be in operation next year, don't we? So an important understanding of reporting financial statements is we anticipate it's going to continue on. If it's not going to continue on, then we need to warn everyone, because who wants to invest in this company who's no longer around? So we assume, I hate that word assume, but we're assuming it's going to continue on as a going entity. Augsburg, we can report all these things. You guys are getting ready to pay your money next year. What good is it if they're doing all this and you don't even know they're shutting down? Make sense? Each entity assumes it's going to continue on for the next year in our financial statements. The business will remain in operation for the foreseeable future. So, when we relate to financial reporting, there are 3 types of principles here. One is called historical cost, which means when a company records their assets, they record them at what they paid for them. So if I show this, well, that's not a good example. Let's say Augsburg. This building, they might have purchased it 70 years ago for $200,000. They've probably had improvements in it of a couple million, and they've had depreciation. On their books, it might be sitting on their books at $300,000. Okay? That's historical cost, what they really have into it. What's it worth? The fair value is probably a heck of a lot more than $300,000, isn't it? But there are certain items that are required to be recorded at historical cost principle. Fair value is something else. Fair value, that assets and liabilities should be reported at fair value, the price received to sell an asset or settle a liability. So there are times when inventory might be worth less than what we paid for it. There are times then we need to adjust that inventory to show the true value because it's less. We're trying to always be conservative, in our financial statements. Let's say that Goodyear you can always trust their tires. Well, their tires failed, and they're going to be paying out big lawsuits. Well, they have to determine what they anticipate today's value of the dollars they might be forking out down the road. So understand that historical cost is how we mainly record assets, record expenses, but there are times that we need to record the fair value, today's value of what the cost may be down the road. I don't want to get too caught up, but know that there are different principles: fair value, cost, and then full disclosure means that companies are required to not just give you these numbers, they're required to explain and disclose in their financial statements any conditions or unique events. So just know those 3 items here. But again, it's like with everything. We could have perfectly accurate financial statements, but it could cost us so much money that we close down the business because we can't even afford it. So this cost restraint means, yeah, we want our numbers to be accurate, but there's really a cost to be paid for having perfect financial statements. So you've got this, what's called a cost restraint, where you've got to have financial statements accurate, but the benefit of having such perfect financial statements can't outweigh to where it's not going to be beneficial for a company to keep going on. For example, sometimes with assets, say Target, do you think they know every single table, everything this and that? No, there's too many assets, and sometimes they have to maybe do some estimates. Is it perfect? No. But to spend the money and energy and time to account for every widget isn't probably worth their while. Do you see what I'm saying, where the cost and the benefit need to play out? Okay, so let's look at these various guidelines, these various principles, and then match them. Ability to easily evaluate one's company's results relative to another. So what happens when we can do what between Delta and American? Compare. Belief that a company will continue to operate in the foreseeable future. What is that? Going concern? The judgment concerning whether an item is large enough to matter to decision makers. What is that? Materiality. The reporting of all information that would make a difference to financial statement users. Full disclosure. The practice of preparing financial statements at regular times. Periodicity. The quality of information that indicates the information makes a difference in the decision. Relevant. Belief that items should be reported on the balance sheet at the price that was paid to acquire them. Historical. A company's use of the same accounting principles and methods from year to year. Consistency. Tracing accounting events to particular companies, economic entity. The desire to minimize errors and bias in financial statements, faithful representation. Reporting only those things that can be measured in dollars, monetary unit. I know to you it seems silly, but this is really key, that you understand that if we don't represent these qualities to be consistent, to compare, to have things that are relevant, do you understand? Our numbers mean nothing. So these 11 items you'll see again. Kind of like this. Know what it means to be consistent. Know what it means to compare. Know what it means to plan on continuing on with an operation. Any questions on that, guys? What is the primary criteria by which accounting information can be judged? Is it consistent, predictive value, usefulness for decision making, or comparability? comparability is a piece of useful decision making, but this information, why are we doing it? To help people ultimately make decisions, okay? I'm not worrying about IFRS. These are international financial accounting standards. We're not going to worry about IFRS at all. Throughout this entire course, I'm not going to mess with IFRS, okay? Sometimes there's so much to cover, you got to not cut out some items that really I don't care about right now. Okay, so what I'd like to do is, let's go